What if the worst investor strategy on paper actually beats most people in real life? Let me show you something that will change how you think about timing the market forever. Imagine you had a rule. You only invest when the market crashes. Not every month. Not on a schedule. Only when everyone else is panicking. Only when the headlines are screaming sell. Only when your stomach is telling you to run. How do you think that strategy performs? Most people assume it would be a disaster. Because nobody can predict crashes. You'd sit in cash for years. You'd miss the rallies. You'd lose. That's the logic. Here's the reality. Researchers looked at a hypothetical investor. Let's call him Bob. Bob had the absolute worst timing in history. He only invested at the very top of the market, right before every major crash. The dot-com collapse, the 2008 financial crisis, every peak, every disaster. Bob bought in at the worst possible moment every single time. And Bob still ended up a millionaire. Not because he was smart, because he never sold. That's the result that changes everything. Now flip that. What if instead of the worst timing you had a different rule? You only invest when the market drops 20% or more. You wait for the crash. You stay in cash until blood is in the streets. Then you buy. Sounds terrifying. Sounds impossible to execute emotionally. And it is. But here's what the data actually shows. Investors who practice this crash-only strategy over a 30-year window still significantly underperformed people who simply invested every single month regardless of conditions. Not because the crash buyers were wrong about prices. They bought at genuine discounts every single time. They were right about the dips. They lost because of what happened in between. While they waited for the next crash, they sat in cash. And cash doesn't compound. Cash doesn't earn. Cash just waits. And while it waited, the market ran 20%, 30%, sometimes 50%, without a single major pullback. And they missed all of it. The opportunity cost of waiting is invisible. But it is enormous. J.P. Morgan researched this. If you missed just the 10 best days in the market over a 20-year period, your returns were cut nearly in half. 10 days out of over 5,000 trading days. And most of those best days happened within 2 weeks of the worst days. The crash and the recovery arrived together. You cannot catch one without being present for both. So, what does this actually mean for you? It means the crash is not your entry signal. The crash is just noise your brain uses to keep you on the sidelines. The real strategy is not smarter timing. It is removing timing from the equation entirely. Here is what works, and what the evidence consistently supports. First, invest on a fixed schedule. Every month, same amount, regardless of what the market is doing. This is called dollar-cost averaging, and it is boring and it is powerful. You automatically buy more shares when prices are low and fewer when prices are high without ever having to think. Second, never hold excess cash waiting for a crash that might not come for years. Every month you sit waiting for the perfect entry is a month. Compounding is not working for you. That silence is expensive. Third, when a crash does happen, do not stop investing. That is the exact moment most people freeze. The market is down 30%, and your instinct says, wait. Do the opposite. Keep the schedule. Buy into the fear. Let the dip work for you automatically because you never changed your system. The investor who beats the crash timer is not the one with better information. It is the one who made investing a decision they never had to make again. You do not need to predict the next crash to build real wealth. You need a system that runs whether the market is up or down, whether it is terrifying or exciting. Set it. Keep it. Let time do the rest. If this shifted how you think about money, hit subscribe and turn on notifications. I will see you in the next one.